Singapore's inflation rate in 2023 is projected to come in at around 4%. As we all look to get the most out of our money, high interest rate savings accounts can be a low-risk way to get better returns, with some advertising rates of over 7%. But getting such attractive rates isn't as simple as just putting your money into a savings account. To get the higher tier of interest, you'll need to fulfill the criteria set by each bank.
So for many high interest savings accounts out there, they have 1+1 sort of options where you can either put your salary with them, credit your salary to them, and then if you do another criteria, whether it is perhaps doing a certain amount of spend on your credit card or buying an insurance plan or investment plan via the bank, that tends to give you more interest.
And here's a sample of how it works. The base rate is just 0.05%. In order to get the advertised rate of up to 8.88%, the customer would have to fulfill a range of crediting and spending transactions, many of which include a minimum sum. When shopping around for a high interest rate savings account, consumers also need to work out what is the effective interest rate. And it isn't always the same as the advertised rate.
I will liken this to walking past a shopping center and looking and seeing this big sign that says 50% discount. And upon closer inspection, in a much smaller font, you will see the words up to. And that really goes to show that not every single thing in the shop is going at 50% discount. So when you actually look into these high interest savings accounts, the interest rate that you get is not necessarily applied equally amongst all the buckets of money that you have inside the account. Some banks actually tier it so that only for the first 20,000 that you have, you get a certain interest rates, and then only for the next 20,000 that you have, it's a different interest rate. So it really depends on what combination of things that you do, as well as how much money you have in that bank, in order for you to be able to calculate your interest rates.
To get the most out of such accounts, you have to see how they fit into your current lifestyle. Experts say there's no point taking on unnecessary extra spending just to tick off the boxes. You have to do your sums and be sure that the extra interest is really worth it.
Customers should do a bit of homework. They should know not just how it works, but what do those conditions mean for them in terms of lifestyle, in terms of personal financial planning goals, in terms of debt management. Does it mean, certain spending patterns will change, or they have to up tier their spending or spend through a particular channel? What does that mean in terms of their, not just dollars and cents, but in terms of consumer choice? If you have 50,000 in your savings account, 1% more translates to $500 more a year. Divide that by 12, I think you only probably get how many dollars a month? $40 or whatever. Are you going to spend for the larger cup by paying $200 more a month for a regular savings plan or insurance product just to save $40? You got to see whether it makes sense for you, right?
While interest rates around the world have gone up over the past year, there's no guarantee that rates will stay the same. So what should you do with your high interest rate savings account if interest rates come down?
It's actually very simple. Keep them open. For high interest savings account, it does actually move with what the interest rates are. So during the period of COVID, interest rates actually dropped to a very low amount where it didn't necessarily make a lot more sense to put your money in a high interest savings account compared to a normal savings account. But nonetheless, it is still higher. And whilst you may not be getting as much interest on that account, that's not to say you should close it. Keep it open. Keep certain amount of money there. You will still need a place to keep money that you're going to spend anyway, and it's still earning more than what it would elsewhere. However, for everything that is outside of that minimum savings or the minimum amount that you need to have in your bank in order to pay for your everyday expenses, you could perhaps choose to deploy them somewhere else where you may get greater returns. And when interest rates go up, you can put your money back and get that high interest that you used to get once again.
High interest rate savings accounts can have a lot of upsides, but you need to be aware of some of the drawbacks as well.
They shouldn't get on to a plan, a policy, for example, or insurance, or going to an investment arrangement if it's something that they either not familiar with or they have not done a proper analysis, perhaps with a financial advisor, as to whether these products are suitable for them. They should still go back to the fundamentals.
I think the one thing that really customers shouldn't do is to go out of your way and potentially spend beyond your means. A lot of these accounts are linked to credit cards that the bank offer, and obviously the more you spend on your card, the better interest you get. But you shouldn't be going out of your way to add an extra $50 spend in order to get maybe 0.2 more interest rates instead. So rather than doing that, find something that suits your current lifestyle, take advantage of that.